mentioned before earlier today, looking at some very interesting things on the crypto charts after the little drop we had on Friday, the little rise we had on Saturday, and the kind of sideways, but up and down we've seen so far today on Sunday. And so the question is, what is the crypto market likely to do this next coming week, with the time frame of the weekly time frame starting a new candle in about whatever it is, 16 hours or so, 18 hours, whatever that's going to be, like 8 p.m. U.S. Eastern Time, Sunday evening, right? That's when the new Bitcoin Weekly is in, and obviously, many other cryptos that start their week at the same time as Bitcoin. So, is this next week going to be more of a week that goes up or more of a week that goes down? And the obvious answer, anybody who knows that I trade low time frame volatility, entropy, probability, and statistics, is the VEPs, right? The acronym for those things. The VEPs will tell you in advance which way it's going to go on any particular time frame. And obviously, the lower time frame, the more occurrences of opportunity there will be, and the higher the time frame, the more probability that there will be changes happening on the lower time frames that affect the outcome of the higher time frames, right? So, if you get a weekly forecast, if you will, at the beginning of the week, yes, the general direction may be good. The probabilities are good that it will be good. But what happens on the lower time frame will very much impact the size of that. And of course, it can completely go the other way, because what seems to be one way at the beginning of the week, which is then affected by real-time data, can certainly change around and go from being a positive week to a negative week, or a negative week to a positive week fairly quickly, especially if you have any significant moves on the lower time frames that affect the higher time frames. So, what does that mean? Well, it means, for one thing, that's why it is more rewarding for day traders to trade lower time frames than to try to swing trade or even hold long or high time frame positions, like on the hourly time frame or the 9-minute or the 4-hour or the daily. Now, it doesn't mean that you can't hold a trade for hours during the day. You certainly can. But probabilities of the price only going one way and the returns only going one way for hours at a time is pretty much nil, right? It doesn't happen. Yes, you have hourly candles that go up one after another, even sometimes the whole day practically. But even so, you'll still have maybe one or two of those candles a little bit down or flat at the bare minimum, usually. And within those hours, you'll obviously have a lot of occurrences of opportunity where you get hilltops and valley bottoms, where you can buy low and sell high when you're trading. And it's important to remember that, because if you see a hilltop where you should be taking profit, or a valley low where you should be taking profit if you're shorting, basically, if you see an occurrence of opportunity to enter or to exit, generally speaking, when you're a low time frame trader, you want to take that. Okay. Now, in the bigger picture of what is likely to happen this week, what we are seeing is, so far, more ongoing development of the VEPs that existed already for this week. So, for example, this week, at the outset of the week, the probability was high that we would see by the end of the week the price coming down. But in the meantime, we saw there would be plenty of volatility with the probability of price action going up and down and up and back down again. And sure enough, that's pretty much exactly what happened the whole week, starting, Sunday night, Monday, right? Prices zigzagged all over the place. And to the general effect of, in the last few days, Friday, Saturday, and Sunday, we saw it dump out pretty hard on Friday, making it a fairly negative week, and then bounce back a little bit on Saturday, and then continue to try to recover some of that, but really it's just zigzagging right now on Sunday. What does that mean? It means that the probabilities forecast for this week on, for example, the AVRs of the weekly time frame and the 5-day and the 3-day and the 1-day were all very, very accurate, as they usually are, because probabilities. And of course, the probabilities on the lower time frames are really accurate as well, because they're calculating low time frame volatility, which is where where the action happens. Right? Actions happen in an instant with a trade. The moment somebody puts in an order and it's filled, that's it. Game on. Right? The order is running. It happens in an instant. Even if you're trading on the daily time frame, your trade isn't entered over the period of a day. It's entered the moment you enter the trade. Yeah, maybe you're buying 100 Bitcoins over the period of 20 to 24 hours, if you happen to be so fortunate, or you're selling 100 Bitcoins or whatever. And maybe you're doing that split up into a bunch of transactions or a bunch of trades, but you're doing it in each instance in an instance, meaning it's not taking 24 hours for your transaction or for your order to be executed. If you're running limit orders, it might take you a couple extra seconds, as long as you don't miss the entry because you put your entry too far away, or because you weren't, your order wasn't filled for whatever reason. It wasn't maybe near the front of the queue of orders, so you didn't get your order filled. But typically, and obviously if you're running market orders, you get instant fills, but typically, even on limit orders, you get your orders filled fairly quickly. If your entry is anywhere near the market rate and there is enough liquidity happening on the asset you're trading, then you'll typically see your order filled, fairly quickly. It could even be within seconds, like just a few or a couple, right? It can even be instant. It's just that with the limit order, you don't get a guarantee of an instant fill, right? And yeah, you might not get filled at all, especially if your order is, very tiny and you're trading at a time when there's not a lot of action, not a lot of liquidity happening, all that stuff. And you're not, and you're at the back end of the book. So you might entirely miss the occurrence of opportunity at your limit entry price. Same thing with your limit exit price, right? And that is why, for example, if you are trying to limit out and suddenly it runs away from you and you see that the VEPs are telling you it's going to keep running away from you, then, generally what I do in that rare instance, because it is rare that that happens, but it does happen, right, is I'll mark it out. Because if the VEPs is telling me this thing's going the other way, you're about to, lose profit, or you're about to lose money in general, you're going to lose the trade. I'd rather pay a tiny market out fee for that 1 in 100 or whatever times that I have to do that than to lose a significant portion because I was waiting for a limit order. But that doesn't mean I enter a stop loss ahead of time, because stop losses are just market orders. They're just literally market orders sitting on the books, telling the exchange where your point of pain is, and at what price you're willing to say, okay, I give up, take my money, which basically says how much money you're willing to give to them. And the exchanges have the means and the resources to drain your wallet that way, because they have plenty, and I mean plenty, of resources available if you're trading on a liquid exchange. Right? They got the manpower, they got the computing power, they see all the information about your trade, and they will trade against you, in most exchanges. Some exchanges, right, are called A-book exchanges, and in theory, they won't trade against you. But in reality, they do. And the way they do it is they will literally sell order flow information to big whales, right? People who have large accounts. So while the exchange may not technically be trading against you in an A-book exchange, one of their larger clients most definitely is, if not more than one. And if you think that your piddly little $2,000 or $3,000 trade isn't of interest to them, well, I got news for you. 2,000 to 3,000 or 2,000 to 4,000, somewhere in that range, is the average liquidation rate. If you look at CoinGlass, that's their bread and butter. Once a day, an exchange will get lucky and somebody will lose $1 million, $2 million, $10 million, $20 million, whatever. Yay, the exchange made some extra bonus cash. But their bread and butter are the trades that get liquidated for between 2,000 and 4,000, which either the exchange gets directly if they're a B book and they trade it against you, which is, again, most crypto bucket shops are that way, or some whale got it from you and the exchange made a nice little fee for enabling that exchange, right? So, and if they didn't get a fee from you or from the other side of the trade, right? And you traded against a big whale in a limit order to limit order head-to-head competition, they probably paid for that order flow information. So the exchange still made money, because they're going to keep getting that customer, that whale, to keep paying them for that information. And you can say, wait a minute, you mean to tell me that they have access to the information about the orders coming up before I do? Yeah, no, that's exactly what you're saying. That is exactly what I'm saying to you, right? People who have significant bags can pay for additional leading information that people with small bags cannot. It's that simple. And it's not just a data feed like you get from TradingView that's at least, some number of seconds behind, right? It's a little funny. It is real-time order flow information. The reason they offer that is because they know that the people who can afford that have the systems in place and the connection speed, right, to the servers, and they have the position size to be able to exploit that information. They got all the info they need. They got VEPS info. They just see it in a different way than our tools, right? Unless some of them are using our free tools or our paid tools, which certainly could be the case. But most likely, they have their own set of tools, right? And you could say, well, how do you know they're all using VEPs? I don't, actually. And in fact, I know that many retail traders who happen to be whales, who happen to have made some lucky trades over the last 10, 15, 20, 30, 40, 50 years, are using Voodoo TA. And they think it's, the bee's knees. And because they're fabulously wealthy, they think they're great at trading. And maybe they are. But they're still using lagging information. And it would behoove them to not do so. Right? And the ones who don't use the lagging information and who use the leading information like we use are usually the ones who get the most returns. They get the most profit. Why? Because they're using leading information. Why do you think they pay for order flow? Right? So that really is what it comes down to. Right? We're talking about leading information versus lagging information. I'm talking about VEPs versus Voodoo. I don't know about you. I don't want to rely on systems that rely on luck. I want to rely on systems that rely on mathematical, or that are built on mathematical probabilities that are actually relevant to the algorithms running most of the trades on the market. And if I look at the big high time frame of what's happening right now in Bitcoin and crypto, it certainly appears that we are in for quite a week. Now, when I say quite a week, what do I mean? Well, it's going to go up, down, or sideways in terms of the returns and the price action that follows. And more than likely, it's going to shake out a lot of hands. It is going to cut people to ribbons. Why? Because you keep hearing, people in retail space, they pay attention to market news updates, right? And as you know, if you're a VEPS trader, market news updates are basically silly nonsense. Those are lagging information by definition. So they're listening to news telling them, oh my God, the market's about to explode. And then the price falls down 5, 10%. Oh my God, the market's crashing. And then the market bounces up 10, 15, 20%. And people get freaked out. They don't know what to do. They're listening to their favorite YouTuber who keeps telling them interesting things, but somehow keeps getting the direction of price wrong. And for some reason, they keep listening to that person because they seem to be doing well. Yeah, because they're getting you to click on their affiliate links to deposit your hard-earned money onto exchanges for which they get paid a commission every time you win or lose a trade and every time you deposit or withdraw money. How do I know? Well, because I know. I used to market these things. Right? It's a long, long time ago. In a galaxy far, far away. I marketed traditional finance exchanges, alternative finance exchanges, you name it. Even done crypto exchange marketing. And lots of it. And so they pay influencers and YouTubers and people who have big websites and people who have social media followings and all that stuff. They pay them for every deposit that's made through their affiliate link. For every sign up, you can get sign up bonuses. Even if you don't deposit a penny, they'll still pay them $5 or $10 just because you sign up through their link. And if you deposit half a Bitcoin or whatever, the affiliate gets a good chunk of that. If you lose a trade, affiliates can get paid up to 50% and sometimes even more than 50% of the amount you lost that the exchange would have taken. So if you lost $100 and the exchange would have made whatever, $30 on the trade or something, or $3 or $2 or whatever it is, they're going to give half or more to the influencer. Now, why would they pay more than half to the influencer? Because they can rely on that influencer to bring them many people over the course of time. And the more they're willing to pay that influencer, the more that influencer is willing to shill their link. Like, this isn't rocket science. This is very obvious marketing 101. And what do you know? I happen to be a marketer. In addition to a crypto trader, right? And trader of other things, but mainly crypto. So what I'm saying is, don't follow affiliate links. Or if you do, be aware that that's what's happening. You know, you can certainly follow them, and in theory, whatever, it doesn't matter. But if you do follow the affiliate link to get the extra bonus or whatever, good for you. Go get your free bonuses wherever you like, from whatever YouTube Jimmy you want. But just be aware of their interests when they tell you how to trade. Because normally, they don't have a clue. Normally, they'll be running two different exchanges, two different sets of trades on the same exchange, using very similar or identical looking interfaces with account info. So when they show you their quote unquote screenshots, you know, it's hard or even impossible sometimes to tell whether it's the same profile as the one they showed you the day before. And they have one position that's long and one position that's short, right? Betting the same amount of money. And I call it betting because with them, they are betting because they're using lagging information. So they're telling you, look, my long position is up 400%. Yeah, what they're not telling you is their short position is down, 400% or whatever, 25%, which is the equivalent, right? So if they're making $100 going one way, or $1,000 or $1 million, they're losing just as much on the other side. Now, are they all doing this? No, not every single one. But are a large amount of people doing this? Yes. And how do they get away with it? Well, they get away with it because there's no rules against it. Right? They don't have to show you all of their trades. They just show you the ones they want to show you. Namely, the ones they're losing. And once in a while, they'll pepper it with a losing trade, or a trade to show, oh, I'm temporarily losing, but I'm sticking it out. I'm in it to win it. Why do they do that? So you can be relating to them. So you can relate to them and identify with them and say, oh, even this great trader, who's not really a trader at all, a YouTuber, and he's a shiller, even this great trader has losing days. So I shouldn't feel so bad about losing. It's normal. Guess what? It's not normal if you're a professional trader to lose multiple days in a row or weeks in a row and think that that's normal. You can lose multiple days or weeks in a row, even if you're a professional trader, but it's not normal. And if you do that for a long time, you will very quickly find that you are no longer a professional trader. Because if you're working for a professional bucket shop, they will limit how much you can draw down, and they will basically say you're fired once you've lost a certain amount of money. Which makes a lot of sense because exchanges are not in the business of losing money. They're in the business of making money, hand over fist. So keep that in mind. Right? And don't be fooled by what you see on the screens. Especially when you know they have a direct financial incentive to make you do certain actions. And that means they have to influence you. It's in the name, goddammit. Social media influencers. They are trying to influence you to make you believe that what they're saying is authoritative and correct, even if you know better. And it brings me no pleasure to tell you this, but I think it's only fair that you have at least some voices, and mine being one of them, that care enough to tell you the truth of how it is. So it's not that I'm against trading. No, I'm definitely for trading. But trade smart. Trade better. Trade the VEX. And don't follow what YouTube Jimmy is going to tell you. Oh, here's a triangle. The price is going to go up. Here's an expected move. It's going to go up to this target. They have no idea what they're doing. Even if they're right 1 out of 20 times. Even if they're right 1 out of 10 times. 2 out of 10 times. 3 out of 10 times. They don't know what they're doing. They're guessing. If you're losing more than half your trades, you're not a winning trader by definition. Now, you might make more money than you lose if you win half your trades, but only if you manage your risk properly, because that is the bulk majority of most trading strategies, quote unquote. Risk management. If you have no risk management, you will lose your money. If you want to know how to do risk management and trade with the best information available, check out the Alpha Trading Discord and check out our live streams Monday through Friday, starting at 9 a.m. U.S. Eastern Time. And you can do that by coming to our Discord for free and getting our free volatility starter pack of indicators. Just go to alphatradinghq.com/Discord. Once again, that's alphatradinghq.com/Discord. All right, that's it for now. I'll talk to you guys later. Happy trading.